And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It's the Hump Day edition of The Real Investment Show, getting this week underway. Of course, today is the day. That's right. Today, Nvidia reports earnings. That's going to be the market mover tomorrow for sure, depending on what they say today. Again, it's going to be all about outlook. You know, and here's the problem with Nvidia is that expectations are very, very high. So it's not just beating earnings or beating estimates on revenue, as an example. It's going to have to be also a bright outlook for the future. You know, things are doing great. We've got a lot of demand, those type of things. So the bar is set very high for Nvidia to report earnings today. We'll see what happens, but that is certainly going to impact markets tomorrow, particularly in the technology sector, but all eyes are going to be on that. Get ready to wrap up this week as well. A little bit more economic data out this week. Nothing major really kind of on the horizon for this week. Next week, of course, is Thanksgiving. Thank goodness. It's my favorite holiday of the year. But we'll have 3 days next week of trading. Thursday as a holiday, Friday as a half-day trading. So again, it's going to be very light trading. Most market makers are gone. Most analysts are gone. Most traders are gone. So it's going to be it's basically inmates running the asylum. So normally you get a bit of a rally next week heading into the election and into the holiday, and then a bit of a rally coming out of that. So, you know, we've had this correction over the last couple of days that's pulled kind of some of the froth out of the market. Yesterday, the market opened lower and then finished up higher. So that was good news. We'll talk about that in a moment. But outside of that, corporate profitability is the one thing to kind of keep a watch on. Danny and I are going to talk a little bit about that in more detail this morning. But going into next year, earnings estimates for 2025 have already been ratcheted back down to where they were about a year ago. So what the estimates for earnings were getting much stronger. Everybody was expecting a lot stronger growth. Just in the last 2 months, all that expectation has been wiped out. So basically where analysts thought earnings were going to be in 2025 back in about a year ago. That's where we're back to now. So a big reversal in those expectations, slower earnings growth next year. We're starting to see expectations for profit margins for a lot of these companies begin to slow as well. The important part about this is that earnings are the driver for future growth in the markets, right? So if you look at the year-over-year rate of change in the markets versus the year-over-year rate of change in earnings, that's kind of, you can pretty much derive what your expectation will be for next year, assuming that those numbers come true. Now, most of the time those estimates are too high and they get ratcheted down further. So you have to make a bit of adjustments. But over the last 2 years, the market's been cranking out about 20% a year. That's not going to happen next year if earnings growth is where it is now. You're talking somewhere probably between 6 and 7% growth in the markets next year, maybe 10. On the outside, depending on how earnings growth comes out. But we are definitely going to see a slower return year in the markets next year. And the big risk that we'll talk about this morning, of course, as we get into that, is corporate profitability, which is at all-time highs in terms of a percentage of GDP. So it's just corporate profits have been very elevated. And this is going to be one of the big challenges for President Trump as he takes office. He's going to walk into kind of a supercharged economy that was driven by the Inflation Reduction Act, the CHIPS Act, et cetera, just tons of money being thrown into the economy, lots of deficit spending, et cetera. All that impetus is now at the tail end of that. So one of the challenges he's going to face is slower rates of economic growth as that money gets brought out of the system. So as you're making changes to, institute tariffs or cut taxes, those type of things, while those will create some growth, you're going to be offset by some of that drag. So it's not going to be smooth sailing next year, and that's kind of the real key message, is that we're going to have to really navigate next year what's going on, and particularly when it comes to Fed rate cuts, monetary policy, et cetera. That's going to be the other big kind of key important driver. But we'll get into that a little bit more this morning with Danny. Here's what you need to know before the bell. So yesterday, again, good action yesterday in the markets. And again, we had this, we had talked about how the post-election rally had gotten markets very deviated from the 50-day moving average. And as always is the case, is that when you have those big deviations, you're going to get a pullback in the market. It's like gravity, as we've talked about before. Came back down, tested the 20-day moving average 3 times. We did it on on Friday, Monday, and Tuesday. Came down, touched the 20-day moving average, bounced right off of that, and then closed higher. So far right now, we've got a good kind of successful test of the 20-day moving average. Futures are pointing higher this morning, so we should get a little bit of follow through here. We do have a sell signal here in the short term. Now, again, sometimes these sell signals occur, but they're very limited. In fact, we can kind of come back and look at, back in October, we had the market come down, test the 20-day moving average, triggered a sell signal very temporarily. Then the market bounced off the 20-day, continued higher, reversed that sell signal. So again, that can happen at these high levels. We can kind of flip back and forth a little bit with these shorter term moving averages. So all it suggests is right now is that the upside's likely limited until you get back onto that buy signal, and then the markets can kind of make its move higher into year end. But again, I just caution you is that over the next week or two, expect a little bit of volatility because of the holiday shortened week. And then we've got mutual fund distributions, as we talked about the other day, starting in the second week of December. So it's not going to be just smooth sailing into year end. To expect some bumps along the way, but the market should end higher than where they are now. In fact, over the last, kind of over history, whenever you have a 20% return year by November, which we've had, about 80% of the time the markets end even higher than where they were by November. So again, the kind of the year-end positioning for a move higher here is important. Now, there are some caveats to this. The amount of exuberance, if we take a look at equity positioning by professional managers, it's gotten very bullish very quickly. Asset allocations by investors are at all-time highs. So everybody's in this boat right now. And in fact, if you take a look at money flows into equity markets. We have the highest flows in history ever into the markets right now. So everybody is invested in the markets at the moment. You know, there's an old saying about when everybody's in the pool. Well, everybody's in the equity pool right now. So that is some risk that not necessarily in the near term. In the near term, when everybody's in and everybody's buying, right? That's momentum, and that drives prices higher, which is what we've seen going on. But the other side of this risk is that when we get into next year, if everybody's already bought, who's left to buy? That's going to be the big question, because again, we've just had this really large move over the last 2 years. In fact, you know, if we just kind of go back and look, this has been, you know, quite the trip since we really saw the markets back in October of last year. We came off that kind of bear market in October and have just had this really accelerated kind of 45-degree rise in the markets over the last couple of years. That's not abnormal following a big 20% drawdown in the markets, which we had in 2022, but it's just been a very accelerated rise here. So again, just a lot of exuberance. And again, I just want to caution you that while there's nothing really worrying the markets right now into year end, once we get into next year, it may become a little bit more challenging environment. So we need to be a little bit prepared for that. So as we start getting closer to year end, we'll talk about year end rebalancing, positioning, those type of things. But we'll get more into that once we get into December. But that's what you need to know before the bell this morning. Danny will be here to talk a little bit about corporate profitability. We've got some other stuff to get into as well. So stick around. The Real Investment Show will continue right after this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So a couple of things that we'll get into today is, of course, first of all, just as we get ready to approach year end, as I said, we'll get more into kind of strategy once we get into December. But since Danny's here, this is just kind of a good time to hit some of the things you need to start thinking about. Because these things, if you have an advisor, do your advisor a favor and do a little bit of this work now, rather than waiting until the last 3 days of the year to do stuff before the end of the year. I mean, there are things that we have to do, RMDs, those type of things. You've got to get those done before December 31st. don't wait until the last 2 days, because everybody, there's always a big rush. Same thing for us. We have thousands of clients, and at the month of December is like April for tax accountants because everybody's got to do all this stuff the year end. So try to be a little bit proactive. Do some of this stuff now. Don't postpone it. Because you run the risk of things falling through the cracks, emails getting missed, those type of things, just because there's such a huge rush. So do yourself a favor, kind of take a little early step. Make sure your RMDs are done. But Danny, there's a lot of things, tax loss selling, those type of things. But Danny, any kind of a short list of year-end stuff to start thinking about right now?
Oh yeah, we could spend a long time on this. We spent a little bit of time.
Let's just do a quick
Friday.
list.
Yeah. Well, Lance, thanks for giving me the floor here. Oh, man. But that's a great point. RMDs, I think, are one that many people delay trying to wait, especially if they're thinking, okay, hey, the market's going to continue to run, don't want to sell out, move to cash. You can do RMDs and potentially just move out the actual positions. That could be a strategy you could utilize if you still want to remain invested, or sell, turn around, put it in your taxable account, and use those funds then. Another one with RMDs, though, Lance, is the qualified charitable distribution. So if you are taking required minimum distributions from those retirement accounts, you can actually use up to $100,000 if you're so inclined to donate to charity. So while it doesn't get you that big tax break like you would if you're donating with after-tax funds, this will actually reduce your taxable income because you're just donating directly out of that account. So be mindful. You need to actually get this stuff in place now, because this is not something you'd like to try to do at the very end of the month in December. And, I get it. I understand you want to see if the market continues to run, but we've had custodians we've dealt with in the past we no longer work with, I'll leave them nameless, who have told us that, hey, if you don't get stuff done by, say, mid-December, we're not going to be able to execute potentially, or we can't guarantee that we can. Now, most places will allow you to do it up till the last minute, but I would caution against that just because, people are on vacation, things happen. Go ahead and get these things in place first couple of weeks in December if you have not already. So that's one thing I think that you should be considering with those RMDs. Roth conversions, we talk about those a lot. They are not for everyone. We have a lot of clients that run analysis that end up not doing it, or doing a much smaller amount than what they had anticipated because of the potential impact for other things such as IRMA for Medicare premiums, Social Security taxation, just small things that we need to think about. Now, if you're not at retirement age, there's still ways for you to do things similar to this, where you could do a conversion. You could also, if you're contributing to a 401k, look at maxing out or putting funds into the Roth. Consider, though, where you will end up with your taxes on a year-over-year basis. HSAs, an easy thing, max out those 401ks, but HSAs, I think, are easily overlooked. So those health savings accounts, they're much different than flexible spending accounts. You can go ahead and utilize these funds. Put them aside so you can do $4,150 if you're an individual. If you're married filing jointly, you can do up to $8,300 a year. Don't use those like that flexible spending account. Once again, use those funds, put the funds into the account. Do not use them. If you can pay medical expenses out of pocket, that's ideal. This is a medical retirement account. HealthView Services, Fidelity, they estimate that a couple at 65 will spend $350,000 to $400,000 in retirement on just medical expenses. So let those funds grow. Invest them if you can. But I always like to leave a little bit of cash in those in case something happens. You need to pay premiums, things pop up. But that is one of the bigger ones, Lance, that I think a lot of people just either misuse or don't fully fund. I wish we could fund it quite a bit more. It is a great account. It allows you for triple tax benefit. Tax-free funds go in, grows tax-free, assuming you use for medical expenses. You're going to get those funds out of there paying no taxes. So kind of like a Roth, but better.
Right. And since all the people in our chat right now, in particular on our YouTube channel, are all millionaires and billionaires, because they listen to the show and they trade their money, right? Donor advised funds. This is one that it takes time to set up, and if you're thinking about doing a donor advised fund, this is something you better start now because it takes time.
Yeah, we had a client yesterday who just said, "Hey, I've got the inkling to do something like this."
Could you explain what that is real quick?
Yeah. So these donor advised funds allow you to actually put funds into an account, like we use Fidelity, for instance, and you get the tax deduction now. So like you're giving to a charity. We use these often when we have somebody who has a high income year, a liquidity event. This is the ability to go ahead and say bundles, what we would call it, where you're putting additional funds. So just to break it down real easy, let's say you give $10,000 to your church each and every year, and you may say, you know what, over the next 5 years, I'm going to give $10,000 every year. Now, instead of doing that each and every year, if you have a very high income year, you may decide to do $50,000 this year, and then not actually gift those funds until subsequent years. So it allows you for a larger tax break this year. You do have to be cautious. And so I know there's a lot of thought with, this Trump tax code. Is there some permanency to it? The margins are very small in the House and Senate to get things done, meaning the majority is just not super high. And so I think that it may be a little bit more difficult path than many think. I think something will get done, but we have to think about right now, where are the standard deductions? Standard deductions are going to be cut in half, so you may want to actually itemize later down the road if that's the case. I'd like to think even with the Roth, with these deductions, that we're going to have a little bit longer time frame where maybe our back's not against the wall like we once thought it was, where they all sunset in 2025. So 2026, we revert back to the old tax code. We see brackets condense. We see them increase a tad bit. That can become an issue. So you need to think about this with your CPA. Think about it with whoever does your taxes. If it's you, great. But you need to understand that there may be some bigger bandwidth in the future if something's not done. And that's the problem with the tax game right now, is there's a lot of things in the air. There's a lot of hypotheticals to deal with. And it makes it a bit more of a challenge than if we had something that was kind of set it and forget it.
Right, exactly. So, again, the point here is just the conversation is there's a lot of things to do. And again, and Danny didn't really touch on just doing things like tax loss selling, tax loss harvesting, et cetera. Those have to be done before the end of the year as well.
Yeah.
If you need to make IRA contributions and Roth contributions, those can be done up till tax day. But those are all things that you've got to do before the year end, and it's just good planning and good process. But don't help your advisor out a little bit, because just remember, it's not just your advisor doesn't have just one client. He's got lots of people all wanting to do the same thing at the same time. So be a little bit proactive here. It'll work out better for you, I promise.
Well, and that's a good point, because we do have a lot of people that have never been inclined to do something, and then all of a sudden it pops up and like, hey, you know what? I'm ready to go ahead and let's try to look at that. And it does take a lot of work on the back end, right? Number one, you need to have a financial plan done if we're going to look at a conversion. We need to know, what your tax situation looks like and have a very good idea. Now, this is the busier time for us doing this, because historically, when you look at doing a conversion, it used to be that we could do them anytime during the year. If, you took a little too much out, you could always put it back. Now, with the tax code we currently have, Tax Cuts and Jobs Act, we cannot go recharacterize those Roth conversions. So be mindful of that. The other thing that I think a lot of people are doing, and you have a little bit more time frame, is that backdoor Roth.
Mm-hmm.
That's always a big thing that pops up. And you have to be careful for the pro rata rule, where part of those non-deductible contributions to a traditional IRA, moving them to the Roth could actually spark a tax. So you could actually be taxed on those funds, even though you didn't get a tax deduction, if you have funds in an IRA. So they look at that on a pro rata basis. They tax you on a portion of that. And that catches people by surprise as well. You mentioned the tax loss harvesting. I think that's a great tool. Remember the 30-day wash sale rule. So if you get out of one position, and we'll pick on, just say Apple. If you're in Apple and you sell it at a loss, well, that's a bad example, but because most people probably are selling that at a loss. But either way, you get the point. So if you sell at a loss, you need to wait 30 days before you get back into that same exact position. Now, there's other positions that you could buy that maybe act similar that you could go out and look at. You could go buy the ETF. You could go buy something that has that position in it. But just know that loss will be disallowed if you don't follow that rule. Yeah. So be cautious.
The wash sale rule gets real cloudy around ETFs, because, for instance, you can have, I could sell a Vanguard S&P 500 ETF, and I could turn right around and buy a BlackRock S&P 500 ETF. And even though they both track the same index, they're different things. So just, be careful with the tax loss rules. There's some gray areas in there that can trip you up. So, kind of the best methodology is, if you're not sure, don't do it. Just wait 30 days, right? So if you sell an S&P index ETF as an example, buy the Qs, right? Just buy a different index if you're just trying to get upside. But again, you probably don't have losses in those anyway. So
yeah, I mean, this is a challenging year. And so it's kind of funny if we have positions that didn't perform like we liked. And there's years, a couple years ago, we sold something and everybody's like, why would we sell that? We're like, well, whoa, we still have a conviction in it, but we'll come back and we may change the investment vehicle. But we want to harvest those losses even in other times because we can carry those forward. And that's one thing that, we talked to a lot of people about. And it seems to be there's a misconception about carry forward losses. So most people understand you have $3,000 that you can carry forward and use each and every year. But anything in addition to that, you can use against capital gains in subsequent years.
Right.
And so a great tax tool, a great way for you to keep more money in your pocket over time. I know it hurts because nobody likes to sell things at a loss.
Yeah. But the trick to that is make sure you carry those losses over on your taxes every year.
CPA needs to know.
Yeah, absolutely. So, all right, quick break. We'll come back. We're going to talk a little bit about corporate profits heading into next year. It's one of the big risks for the markets and the outlook. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My son, Thomas, who really good-looking kid. And so he's starting a business for Thanksgiving to provide Thanksgiving packages.
The Real Investment Show podcast.
For $75, he'll show up at Thanksgiving, with a girl and tell a cute story of how they met. He'll stay through dinner and then, give the parents a hug on the way out.
Same show, your schedule.
Quite a business idea. I wonder if there's a package in there where he wears the matching ugly Christmas sweater.
At realinvestmentadvice.com.
No, that's the Christmas package. That's deal. Coming up.
Okay,
so yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So corporate profitability is, as I said, one of the things that is going to be key to be paying attention to as we move into 2025, because corporate profits as a percentage of GDP is at all-time highs, and not by a little bit, it's by a lot. So that ratio is going to be much harder to keep up with as we go forward. And so, this is going to be really important in terms of looking at the overall economy. But I thought it was interesting, just talking about corporate profitability. Walmart yesterday announced really great earnings, and stock was up, or actually, let's see, today's Wednesday. So on Monday evening, announced good earnings, and then on Tuesday, stock was up nicely, about 4.5%. Kind of really firing on all cylinders. Walmart's doing really well. Today, Target announced earnings this morning, and they had basically a disastrous report. Their earnings fell 12% versus a year earlier. Revenues rose just 1% to $25 billion. Analysts expected them to deliver $2.30 a share. So they are not even, like, there's a ballpark, and then there's the hockey rink next to the ballpark. They're in the Little League baseball field about 6 miles away, not even close to the ballpark of where they need to be in terms of earnings. The stock's gonna be down 20% this morning at the open. But it's interesting because this is, Target has been under a lot of pressure over the last year. So, they had their whole endeavor into being woke, and that didn't work out so well. And that's really continued to kind of languish, on their sales. And we've seen, and there's obviously been a lot of transition from Target to Walmart. So, Walmart is talking about customer foot traffic's doing well. They have a lot of excitement going into holidays. And then you have a very comparable store that is just basically falling apart at the seams here. So it's going to be interesting to watch this morning, but Target's going to be down very, very sharply. We'll see if they get a little bit of recovery sometime today. But again, this is my point, though, going into next year, is that it's going to be a question of the haves and have-nots for the most part when it comes to picking stocks next year. While fundamentals haven't seemed to matter over the course of the last few years, because everything's just going up at the same time, I think we're about to get into a cycle where fundamentals are going to start mattering a lot more in terms of what companies do you own versus what companies do you not own, particularly under this new administration who's going after specific target areas. Like, for instance, we talked a little bit about yesterday on our investment committee meeting about Robert Kennedy, and as kind of going after some of the big pharmaceutical companies, in particular the vaccine makers. So those potentially have a lot of risk, where healthcare providers in general may not have as much risk. So it's going to be something you've got to really kind of work through your analysis with. And we may very well get into an environment next year where stock picking does a whole lot better than actual ETF buying, kind of passive investing. And so this could be one of those years where we see that. We'll see. But this comes down to corporate profits. And again, Danny, this is, one of the big risks with corporate profitability right now. It's been very high because of all of the past, monetary interventions, fiscal interventions, just the IRA Act, the Infrastructure Act, the CHIPS Act. There's just been billions and billions of dollars kind of pushed into the economy. Corporate profits, and I've got an article coming out on this that explains this in much more detail, but corporate profits are derived from investments and dividends, less household savings, less government savings. And if household savings are negative, in other words, basically savings are declining, savings rates are declining, and if government savings are negative, in other words, we're running a deficit, those take away from corporate profitability. So if you begin to reverse those, right, if you start to reduce the deficit, if you start to reduce the amount of debt you're spending every year, that's going to impair corporate profitability. So again, that's going to have a reversal in that prospect, and that's one of the concerns going into 2025 is that Trump wants to do things to like cut $2 trillion off the deficit. That's a negative to corporate profitability. So something we're going to have to think about next year in more detail, Danny.
Yeah, I think that's such a fine line when you think about all the agenda items that we're looking at. You're looking at tariffs, and you're looking on the other side of cutting government spending, which is such a huge amount. We look at just the job numbers. I mean, you think about how many government employees have consistently been hired. But going back to the point on inflation, and essentially, looking at auto and credit, we talked about this not long ago, was that, we're seeing these remain extremely elevated. And so if you don't see, wage growth increasing and people making more money, at some point, that camel's back is going to break. There's no way around it. And so for how long can these companies continue to extend credit card limits, can continue to allow people to spend on that? And so if we look at that savings rate, then you couple it with where people are, the problem is that we've been talking about this for a year. It's been since last October that we've remained so elevated.
Right. Brent, bring up this chart for me real quick. It was interesting because just talking about, consumers, because they're they're 70% of the economy, right? Rejection rates on credit cards, mortgage rates, autos, credit card limit increases, and mortgage refinances, rejection rates on all of those factors are rising sharply right now. So banks are getting more conservative about extending credit at a time where household savings are declining,
so people
which is a negative for corporate profitability. That subtracts from corporate profitability, which is going to feed into that loop, right?
Yeah, and you have people trying to make ends meet. And the interesting thing is you look at Walmart, they're anticipating a great, fourth quarter here, a good season. And that's always interesting when you think about that, Walmart versus Target you were just talking about. Like, what is the biggest difference between them? I mean, there's a lot more you can buy at Walmart, I feel like, than Target.
Right.
I don't go to Target.
Why don't you go to Target?
I'm not even going to get into that.
But no, it's interesting because I think a lot of people feel the same way, right?
Yeah, I'm not supporting their ideas.
There you go. So they've chosen to go to, again, if I've got two stores, and look, wherever there's a Target, there's a Walmart.
Yeah.
Right? I mean, they're always next door to each other, right? So if I don't like Target for one reason or the other, and you offend half the population, they're going to go shop at Walmart, right?
Yeah.
So
they
sell the same stuff. They both sell food, right? I go to Target and buy groceries, and I go to Walmart and buy
Yeah, but I think
groceries.
there is a difference between the food. I haven't been there quite some time, but it seems that Target's a little bit more upscale food or more expensive. Pricing's a little bit more. So Walmart's going to have a broader base of people, I feel like, that are going to want to shop there. Or you can go in there and you can get auto stuff. Plus, you can go get,
Plus,
I can shop of milk.
I can shop at Walmart in a bikini with flip-flops.
That you can. I have seen that, which is disturbing. Not Lance in a bikini.
There is a
which
whole,
would be more
yeah,
disturbing.
Actually, true. But yeah, there's a whole TikTok channel set up on 2 a.m. Walmart. So,
man. Well, I've noticed that.
Shop
I think
2 a.m.
people in general,
Walmart.
doesn't matter what time. I'm at the point where I don't even want to go into the store, especially with kids, because they're like, "Hey, Dad." I'm like, "Oh, shoot." I mean, it can be 6:30 in the morning. It may be 10 a.m. It may be 4 p.m. I don't know, but yeah, it's people's dress codes and habits have really, really declined.
Yeah, that's.
I have noticed that
humorous.
Walmart has become a little bit more bougie.
Walmart's more bougie.
Yes.
Since when?
Within the past year.
How?
Okay.
The clothing lines.
Oh, okay.
Yeah.
Okay.
All right.
We'll
I'm
see.
getting you for Christmas. Walmart gift card.
Buy him a suit from Walmart. There you go. But no,
man.
I mean, this all goes back to corporate profitability, and it's interesting. As I was talking about, if you take a look at corporate profitability versus GDP, that's at an all-time high level. But also, if you take a look at corporate profitability just as a function of what they call gross value added, and this is a measure of the inputs into a corporation and what value does that add. Gross corporate profits as a percentage of its GVA is near its all-time peak. So again, this is, we're just moving into that environment where things are very extended, exuberance is very high, and if you have a reversal of any of these economic policies, and again, Danny was talking about taxes, and he's right. He said, the margins are fairly thin between the House and the Senate. So it only takes a couple of people to lose a vote one way or the other that will keep a bill from getting passed. It's very likely that the 2017 tax cuts will get extended. So that's just they'll be made permanent. But the potentially adding new tax cuts may be more challenging because of concerns over the deficit and spending and those type of things. As we talked about before, there's the Freedom Caucus that is in the House, and those members are very against increasing debts and deficits. So, if there's a pushback against further tax cuts because of deficit concerns, then maybe there aren't any more tax cuts. Well, if you don't get additional tax cuts, then basically the boost to corporate profitability doesn't change because all you're doing is just extending the ones that currently exist. So there's no real change to that. And then when you extract out government spending, again, if you start to back out government subsidies, if you back out, reduce the deficit, that's all going to weigh on corporate profitability. So that reversal of profitability will potentially weigh on stock prices. And that's the thing we've got to pay attention to.
But is there better forward guidance moving into 26 versus what we had if we think we're going to get some permanency to this, in the sense that we know the corporations, your taxes are likely going to increase in 26. Now that's going to be permanent. That's got to be something that's factored in at some point.
Well, no, it's getting factored in now. That's why you saw such a huge bump right after the election, because as soon as that election was passed, and it looked like that Republicans were going to control both House and Senate, that's why you had that huge bump in stocks. But you got to remember, the market's already trading very elevated. So they were very overvalued already. And again, corporate profitability as a percentage of GDP is already at all-time highs. So how much boost are you going to get from here is the real question, right?
Yeah. $1 trillion question.
Exactly. All right. Be right back. Get ready to wrap up the show. Don't go away.
It's rock and roll. 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 It's rock and roll.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So one thing to kind of be thinking about also next year as we kind of move forward is talking a little bit about inflation as a function, because if corporate profitability is peaking, the one advantage that companies have had over the last couple of years has been able to push through inflation to consumers. And if consumers are slowing down, again, as we were talking about just a second ago, if with credit rejections rising, with savings rates declining, the ability to consume is slowing down, and so we'll continue to see that as we go forward. Well, if I can't sell products, and again, so let's just take Target as an example here. I've got a lot of inventory. In fact, there was an interesting article out this morning on the Wall Street Journal talking about how companies are stocking up on product ahead of potential tariffs. So they're buying a lot of product now and starting to build inventory. Well, if I can't sell my inventory at the current price in order to get it sold and get it off my books, and particularly if it's a perishable item, I've got to put it on sale. And so I have to start cutting into my profit margins to get rid of that inventory. And so this is something that potentially that we'll see kind of moving forward a bit. Another thing we're seeing companies do right now also is that kind of ahead of this idea of tariffs, are already starting to shift manufacturing to other low-cost countries. Again, labor is such a big such a big component of prices and business profitability, et cetera, that I've got to keep labor costs down. And so I can't necessarily bring my labor costs back into the U.S. because our labor costs are much higher than where they are elsewhere in the world. So again, these are all going to be factors that play into corporate profitability next year, is how to navigate the risk of an economic slowdown. And again, we've been very fortunate here because of that Inflation Reduction Act, because of the CHIPS Act. We've had very strong economic growth over the last several quarters as that money has been, just pushed through the economy in various areas. The rest of the world is slowing down. So we're going to import that deflation into the U.S. from those countries, because about 30% of kind of 30 to 40%, depending on how you calculate it, of exports that we sell to other countries, come from U.S. companies that we sell overseas. About 40% of that is factored into that corporate profitability factor. So again, if their economies are slowing down, they can't afford to pay the prices. We've got to start cutting costs, and that's going to eat into corporate profits. So again, this is the kind of the whole inflation factor, the economic growth factor. These are the things that are going to become a lot more challenging as we head into next year and start thinking about where to allocate money.
Well, and also the allocation of money. I like what you said about fundamentals, because they have not meant a whole lot for quite some while. And at some point, they have to mean something. The other thing I think that a lot of people are, we keep talking about, what is the impact here? What does the forecast look like for 2025? And you hear so many different numbers. I had somebody. A good friend emailed me something this week and said, hey, Goldman said that the market's going to be up 11% next year. I'm like, yeah, but the problem is that's going to change every quarter, right? They're going to go back and revise that downward or upward based on where markets are. And that's going to be that way with every single one of these outlooks.
Yeah, and you can bet today that those earnings estimates for Target are getting slashed.
Oh, no doubt. And therefore, it's going to be easier for them to beat over time.
Sure, absolutely.
And that's the problem with this game that's played with analysts, is that it's historically always slashed, so that hurdle becomes lower and lower and lower. So that bar is not very difficult to get over. And then the market thinks, oh, wow, this is great. Well, this is not nearly as good as what everybody expected or thought. And yet the market continues to run. Share buybacks, all the things that we've seen go on. That looks like that's probably going to continue for some time. What is going to be the impact of that? And does Trump do something to maybe change that, right?
Right. Well, look, as I was talking about this in the opening segment this morning, but here's a chart, exactly what you're talking about. So this is the S&P 500 earnings per share projections over the past year. They started back in November of 2023 at $278 a share. They fell in early January of 24 down to about 273-ish. Then they got stronger all through this year because we had these stronger economic growth, the market surging, everything is great, it's wonderful, the bull market's on a tear, so analysts got very bullish into, August, September, and now since really about September, we are now back to where we were in January of 2024 at the beginning of this year. So now, to your point, Danny, beating that. So now what we got to do is we don't have to beat the $280 a share. We can just beat 274, and it's millennial. Everybody gets a trophy, right? It's millennial earnings season all over again. But this is the game.
So why haven't the markets priced that in?
Well, because again, they don't really pay attention to the estimates.
Yeah.
Right. But what
they do until earnings day, and they say, "Oh, look, we beat." And
right. But this is why valuations are going up. If you take a look at forward valuations are now the highest level we've had since the dot-com peak. And that's because the forward estimate, the E, is coming down and the price of the market's still going up.
Yeah.
So this is always the trick is that, for investors, this is, again, Wall Street trying to sell product, right? They just want to sell you a product. And so they go, oh, look, stocks are cheap based on if this company generates $200 a share in earnings next year, it's really cheap fundamental wise. But then it turns out they only generated $100 a share in earnings, and so now it's not so cheap anymore. But you bought it on this assumption that forward earnings estimate was correct, and this is the trap that investors always get themselves into during bull markets is they way overpay for what the future is actually going to wind up to be.
Yeah. So another thing. We've been talking about. Are we being too narrow-minded? I'm not saying we. I'm just saying in general,
we
investors.
Are very, very narrow-minded.
Yeah, you.
Me, in particular. One-track mind. That's what my wife says.
Yeah.
Yeah.
So, but in general, when you think about the overall broad market, I think, we're forgetting that we're seeing a slowdown in Europe. We're seeing a slowdown in China. What's the overall impact going to be to numbers with that? Because it seems like the average investor has completely just block that out of their mind.
Right. Well,
because they may say, well, I don't own any international. Well, in fact, you do. If you own the S&P 500, a lot of those earnings and revenues are derived from overseas.
About 40% of them.
Yeah.
But no, this is the point that, when, if you've got an inflation push, right? If your thesis is we're going to have runaway inflation over the next several years, you're not, because we import deflation from the rest of the world. We export our inflation to import deflation. And China is in a mess. Europe's in a mess. Japan's in a mess. We're the only country that's growing right now, and we're only growing because of basically $4.5 trillion worth of stimulus, not counting what we did during the pandemic, right? So all that money is there, and that's starting to come back out again, but the rest of the world didn't do that. And so they're suffering the real economic consequences of an economic slowdown that we will import into our inflation numbers over the next 2 years.
Yeah.
So...
And I think that's going to be the difficult challenge that, this next administration is going to inherit is that you have all of these things that have been front ran. How do you continue to do so?
Well, no, that is going to be the real challenge, right? Yeah. And look, there's going to be a big battle between the White House and the Federal Reserve coming, because as those economic impacts, those kind of waves of deflation come rolling back on our shores, there's going to be a big push between President Trump and Jerome Powell to cut rates. We're going to have a replay of 2018 kind of all over again.
Well, I think the challenge is going to be is that, Trump actually is the one who put him in place in 2017. And what his term is up in 2027? 26?
6, 7, yeah.
Yeah, I think he's got a year and a half, 2 years. And so that's going to be a challenge. But he's also a PE guy. He's a private equity guy, right? Yeah. So he worked for Carlyle. He's not exactly your economist that, everybody thinks he is. He's somebody that's probably a little different. Now, I know he said that you can't get him out of office, but there's ways, from what I've understood and read, that they could move him to a governor seat, right? They could do some different things to him, and I'll leave that to Mike Leibowitz to talk more intelligently about. But there's a lot of things that could occur, but is it even worthwhile?
Well, and look, they may squawk at each other.
Yeah.
Right. At the end of the day, they're not going to do they're not going to do anything to each other. Right. At the end of the day, there's just going to remain status quo. So he's not going to fire Powell. He's going to let Powell run his term. Powell is going to cut rates more aggressively when the banks get in trouble. Right. If you start to see collateral values getting suppressed, if you start to see bank earnings getting suppressed, if you start seeing credit stress within the markets, the Fed will cut rates, and they'll cut rates sharply. So far, it's been kind of a boon right now because everything's fine. They've just been able to just kind of slowly cut rates. It's no big deal. That's actually very beneficial for stocks to have a slow rate cutting cycle because, again, there's no economic strain. However, you can bet your bottom dollar that if economic strain shows up because Trump is instituting tariffs, cutting spending, those type of things, and we're starting to see financial stress in the markets, the Fed will start cutting rates. The Fed will start doing QE again to help support that underpinning.
Do you think the Fed's cuts at 50 basis points was premature?
Oh, yeah.
Yeah.
Look, I said that up front, is that they should have cut 25 basis points, see how the market reacted.
Yeah.
And kept the 50 basis point rate cut because there was no financial stress back in September when they cut 50. Everything was fine. Unemployment was low. Markets are doing fine. Credit spreads were very low. There was no risk in the markets. So you cut 25. You keep that 50 basis point cut in your hip pocket in case something popped up and there was all of a sudden a big spike in the SOFR rate or whatever there was that instituted some stress on banks. Then you cut 50.
Yeah.
Right?
Think he's trying to prove a point?
No, I think he just made a mistake.
Well,
but that's just me.
Yeah.
And I'm not Jerome Powell.
Easy to be an armchair quarterback, right?
Exactly. What do I know?
Yeah.
Anyway, all right. Hey, thanks for joining the show today. We appreciate it very much. Danny Ratliff here, of course. If you got questions, and look, if you need help with your year-end planning, don't hesitate to send Danny lots of emails. He has nothing to do. He just sits around all day doing nothing, needs some emails to answer. So get by the website, realinvestmentadvice.com. Click the Ask a Question button. Always happy to help you. Have a great day. We'll see you back here tomorrow with Michael Leibowitz. We'll talk about tariffs and the Fed and what that all means. So, see you then.